So if you've ever wondered why one person gets a $500 limit and another person gets a $25,000 limit from the same bank with the same credit score, then this video is for you. Because the truth is, your credit score is not the full approval story. Banks approve you based on a mix of score, credit profile structure, income, cash flow signals, relationship history, and risk patterns. So today, I really want to break down the exact strategies of what you need to do to make sure your profile is fully built out, and just so you understand how to replicate it the right way when moving through different banks. So we're going to cover 3 lanes. Lane 1 is how to build credit from scratch with institutions that reward relationships. Lane 2 is going to be how people graduate into those higher limit approvals and business funding. Lane 3 is now how to use auto loans and lines of credit without destroying your actual profile. So I'm Brittany Calloway, and I provide insights around credit, business, and finance because the goal is to help business owners turn credit into capital and capital into freedom. So let's get into it. So the core principle is relationship banking. You will constantly hear me say that over and over again because you have to build a relationship with the bank in order to have them trust you. This is not just on a vibe, right? This is literally underwriting. So here's how the banks think. There are 2 types of trust. You have credit bureau trust. That is where they're going to look at your report and say, you have done X, Y, and Z historically with credit, so now we know this is where you kind of fall. You have on-time payments, low utilization, age mix is right, low inquiries, no derogatories. That's one type of trust. Institutional trust is different. This is what the specific banks see that you are doing with them. Your deposits, your average daily balances, how long have you held the accounts with them? Do you overdraft a lot? Do you maintain good cash reserves? Do you pay them on time? Are you profitable? So when you bank with a credit union or a major bank, you are creating an internal data points that the credit bureaus are never going to be able to show the bank. This is why 2 people can both have a 720 score, and one will get approved with the bank and the other one will get denied by the same bank. The bank's not only reading your Experian, Equifax, or TransUnion score, the bank is also reading you. So the strategy is not to just open a card. The strategy is to build a relationship file. Relationship files include checking accounts. Are they open correctly? Meaning there's no random or suspicious activity. There's no constant negative balances. There's some level of deposits, ideally even direct deposit if you can. And the average balances are not constantly zero, right? And has it been longevity with the bank? Because time with a bank also reduces risk. This is why Navy Federal and other credit unions can be powerful. If you actually qualify and you actually behave like a bankable customer, the funding opportunities are going to be endless to you. So starting from scratch, the correct way to build your credit profile and build trust with the banks is through also a secure card and or a pledge loan. So let's break that down. A secure credit card is not a starter card you just settle for. It's an underwriting hack in plain sight. Because with secure credit, the bank is saying, I will approve you because you are collateralizing the risk with real money. Your job is then to convert that approval into trust. How? Use the card monthly, keep the utilization low, pay before the statement date if you want the statement balance low, never carry high balances relative to the limit, never pay late. Then you layer an installment account around that, like a credit builder or a pledge loan style loan. Why? Because revolving credit and installment credit behave differently in scoring models. Installment accounts add on time payment history, credit mix, stability signals. But the bigger point is that you can show you can handle the structured payments. So secure cards is for like revolving behavior. Small installment loan is also going to be mixed, right? And payment stability. Deposits and account tenure is for that institutional trust. So that combo creates a profile that can graduate a 25 to 75K approval with the bank. Also, if you need help with this funding order, you can also grab my Operate Like a Pro business credit card checklist at thefundinglounge.com, where this blueprint is mapped out from start to finish so you don't have to try and recreate the wheel. Now, starter cards are also great for the profile. However, some are better than others. Capital One, for example, isn't my favorite to apply for because they always just give low limits and they have conservative behavior around it. Also, some of those Aspire and Open Sky cards, they charge monthly and can hurt your bank account more than boosting the profile. So those aren't my favorite ones to use. Some issuers are conservative by model. Some issuers reward relationships and growth. Some issuers bucket customers into limit tiers and are slow to graduate them. So the strategy is not what card should I get. The strategy is what issuer behavior matches my long-term goals. And if your goal is big bank funding, then you want issuers that graduate limits upward. They offer multiple products later. They have business products that connect to the personal relationship, and they support future lending like autos and mortgages. That is why relationship-driven institutions are often better longer term than just these random starter issuers. So some starter accounts and credit builders are like Discover It, Cashback, of course, a Chase Freedom Flex, Self Credit Builder, Kickoff Credit Account, Credit Strong, American Express Blue Cash, Everyday American Express, Green Card, Wells Fargo Active Cash, Apple Card from Goldman Sachs. These are just some of the starter cards. Now, some of those credit builders don't build a full-blown relationship, but they are some good starter products that can help a thin file by adding trade lines to them. But not all of them are going to create a banking trusting relationship. So when you go for real funding, underwriters want to see major bank cards, credit unions, auto loan history with real lenders, real installment history with recognized institution, because that's going to show you have low risk, right? When now obviously getting you approved for the funding. And when you have low risk behavior and your report is full of like fintech builders, right? Because low risk behaviors are the best when it comes to this. If your report is built out just with fintech builders, like just credit starters and builders, it's going to look like you're trying to manufacture a profile rather than building one out. So builders can be a supplement. They just can't be the base. If you need them to add depth, fine. But your foundation should be relationships with real lenders. An example is having like a Chase relationship manager. So here's what that means. Large banks often have business bankers, but that's a difference from a relationship manager who handles opening accounts, guiding applications. They do not magically approve you, but they can make sure your profile fits the products, ensure documentation is correct, and help you apply it in the right context. Sometimes having an advocate or escalating a file on your behalf can get you funding really quickly and those larger limits. So the real strategy is to stop applying like a stranger. When you build a good bank relationship correctly, you can also apply like a customer. What do you do before you apply? You got to clean your profile. No late payments, low utilization, no maxed out cards, stable income and deposits. Time has passed since your last credit seeking activity. You're not applying while your report looks like chaos. Then you go into and position it correctly. So if you're building business funding, you should have a real business entity, correct business information consistently across the board, right? Good banking account setup, proper revenue. You want to have a story that just makes sense. And the industry has to align with that product. To mean you have your NAICS codes matched up correctly and they're low risk, they're not high risk approvals. Credit stacking is another way, of course, to now make sure you're getting the maximized approval. But the safe version, I like to call it, is planned sequencing. Sequencing means you apply in order based on which bureau an issuer tends to pull in your state, or your current inquiry sensitivity, or your utilization, or your income in DTI, or your existing relationship, right, with the banks. So we want to make sure we're planning on the rounds that we're doing. So round one, your strongest relationship, bank or credit union, is the lender that's most likely to approve you and give you the most money. So we want to go with them first and based on what bureau they pull from. Round two is the lender that also pre-qualifies you, meaning that you can indicate the approval odds before actually digging yourself and getting a hard inquiry on your file. Round three, the remaining issuer is spaced out with time because lenders get sensitive when you look like you're seeking a lot of credit at the same time. So you can still build out a really good portfolio doing those strategies. Another one is double dipping. It's one of my favorites. What it really means is you're using one inquiry for multiple products. There are legitimate versions of this concept. Some lenders do allow you to apply for multiple products within a short window and treat it as one inquiry, like American Express. You can get 2 blue cash cards on one inquiry for an entity in LLC, and you can apply for 2 of those products in a 30-day period. So these are just some of the tips that I like because it helps you to really build out your profile fast and also get large limits very quickly. So you want to pick institutions with product ecosystems, meaning one relationship opens multiple doors, right? So examples of product ecosystems are credit cards that have business credit cards, that also have auto loans, that also have high credit limits, right? And lines of credit, and also have business bank account products. These are great because, like I said, you have one bank that you're really relationship banking with. So we can really start to get one product and then maximize across the board. Now, auto loans are also going to protect your credit card and your wallet. They say get financing with your institution first. That is top tier advice. So here's why. Dealerships are not there to protect your credit. They are there to maximize their profit. When you let a dealer shop your credit, you risk multiple inquiries, right, across the board that take a while to get off, higher interest rates, add on products that you don't even need, and fees that inflate our true costs. So our method is you get pre-approved first through a bank or a credit union, then you take that approval and you walk into the dealership with your approval to now negotiate the terms. You can negotiate the price separately, the financing separately. Do not let them mix numbers. When you combine price, monthly payment, and financing, right, you got to make sure you're on top and not losing. When you separate them, you win. And when you're pre-approved, you control the deal and the narrative. So that's why I love that better. So when it comes to business lines of credit versus business cards, my favorite product is business lines of credit, but they are hard to get. Why? Because business lines of credit just have harder approvals. They require strong revenue, banking history, financials, and they want to, they're offering cash access directly to you. So it's usually better pricing those sometimes than credit cards, cash conversions. And it's also better for working capital and operational liquidity. So those business cards are good for 0% interest periods and expenses. So I do like those from a business card perspective because it gives you a while to flip that money. But I do like business lines of credit better because the max is just higher and you can actually operate a little bit easier too as well. But you have to graduate into those business lines of credit. So if someone gets stuck just playing only with cards, it's usually because their business is not positioned to qualify for lines yet. Now, let's turn all this into a simple roadmap. Number one, we want to make sure we are building the relationships. So build revolving history with secured or starter products, add installment accounts for the mix, and you want to keep utilization low, no late payments, and keep your credit clean. Phase 2 is now growth. We have to graduate into real lenders. You want to build 2 to 4 major revolving accounts with real banks and real credit card products. Again, maintain low utilization, but increase your income stability signals, right? Do not chase approvals every single week while doing this. Phase 3 is going to be we want to leverage and add that auto loan only when your profile is truly stable. Again, remember, pre-approval first, then go in and negotiate. Next, we get the business cards for leverage. Then we get the business lines of credit when revenue supports it. Phase 4, what you do with the capital is the goal with this, right? Put money into assets and systems, not liabilities. So the real message is about understanding that credit is a relationship game. Your report is your resume. Your bank history is your references. And your behavior is your character. If you build all three, funding is going to become predictable for you.